Berlin, November 1923. A woman named Frieda Schultz pushes a wheelbarrow through the frostbitten streets, the wooden cart overflowing with German papier marks. She is heading to the bakery. Not for a feast, not for a week's worth of bread, but for a single loaf. The currency she carries weighs more than the food she will receive. The exchange rate that morning reached 4.2 trillion marks to $1. By evening, it would be worse. Across the city, workers are paid twice daily because waiting until the end of the shift means their wages become worthless. Restaurants stop printing prices on menus. Pensioners watch life savings evaporate into mathematical absurdity. And yet, in a quiet apartment 3 blocks from where Frieda struggles with her wheelbarrow, a man named Heinrich Braun sits calmly at his kitchen table. He is not panicking. He is not desperate. In his hand, he holds a single object that weighs less than 2 ounces, a small gold coin inherited from his grandfather, worth nothing official in the madness outside, yet somehow worth everything. Within 18 months, when the chaos ends and a new currency called the Rentenmark restores order, Heinrich will exchange that coin for enough money to purchase an entire apartment building in central Berlin. This is the story that history rarely tells you. This is what gold actually does during economic collapse, and it is nothing like what most people believe. If you have been watching financial content for any length of time, you have probably encountered the gold for barter fantasy. The collapse comes, the dollar dies, and suddenly you are trading gold coins for groceries at the local farmer's market like some kind of post-apocalyptic merchant. It is a compelling image. It is also almost entirely fictional. The reality of gold during economic crisis is far more interesting, far more strategic, and far more useful if you actually understand it. Today, we are going to dismantle the mythology and replace it with something better: the truth. If this is your first time here at Infinite Wealth Historian, consider subscribing because we do not deal in fantasy. We deal in patterns that repeat across centuries. And if you have ever wondered why central banks are hoarding gold at the fastest pace in 60 years, while simultaneously telling the public it is a barbaric relic, comment below with your theory. I have mine. But first, let us understand what gold actually is and what it is not. The barter myth comes from a fundamental misunderstanding of how economic collapses actually unfold. People imagine a sudden, dramatic moment where the currency dies and everyone immediately needs a new medium of exchange. In reality, currency collapses are processes, not events. They happen in waves, they happen in phases. And during the acute phase, the chaotic middle where prices double daily and society teeters on the edge, gold is almost useless for daily transactions. This is not speculation. This is documented history across every major currency collapse of the last century. In Weimar Germany, during the worst months of hyperinflation, the primary medium of exchange was not gold. It was foreign currency, primarily US dollars and Swiss francs, along with direct barter of goods and services. In Argentina, during the 2001 peso collapse, people used dollars stuffed under mattresses. In Venezuela, during the ongoing Bolivar disintegration, the informal economy runs on dollars transferred through mobile apps. In Zimbabwe, during the 2008 hyperinflation that peaked at 89.7 sextillion%, people traded goods directly or used South African rand and US dollars. Notice what is absent from all these examples. Gold. This is not because gold lacks value. It is because gold has too much value for daily transactions during crisis. When bread costs 1 million units of collapsing currency, you do not pay with gold, because gold cannot make change. A 1-ounce gold coin today is worth roughly $2,000. How exactly do you buy eggs with that? How do you purchase gasoline? The denomination problem makes gold impractical as a circulating medium in crisis. More importantly, using gold during the acute phase of collapse is strategically foolish. It is like burning furniture to stay warm while sitting next to a forest of firewood. You are consuming your most precious asset at the worst possible exchange rate. People who understand gold do not spend it during collapse, they spend it after. Here is the pattern that repeats with almost mechanical consistency across history. A currency crisis begins. The acute phase lasts months, sometimes years. During this phase, people survive using whatever alternative is available, usually foreign currency, barter, and personal credit within communities. Then the crisis resolves. It always resolves, either through default, redenomination, currency board, dollarization, or some other stabilization mechanism. And in that moment of reset, when a new monetary order emerges from the ashes of the old, gold reveals its true function. It is the bridge. It is the wealth that survives the crossing. Heinrich Braun did not use his gold coin to buy bread in November 1923. He waited. He held. He watched the chaos from a position of psychological security, because he knew he possessed something that would outlast the madness. When the Rentenmark was introduced in late 1923, backed by land and indexed to gold, the reset occurred. And those who had preserved gold through the collapse found themselves holding assets that had appreciated in real terms by a factor of 10, 20, sometimes 50 compared to their pre-collapse purchasing power relative to real assets like property. This is what smart money has always understood. Gold is not a transaction medium during collapse. Gold is collapse insurance. It is generational wealth preservation. It is the thing you hold so that when the system resets, you are not starting from zero. Consider the mechanics of what happens to gold during currency destruction. As the purchasing power of paper money evaporates, the nominal price of gold in that currency explodes upward. In Venezuela, between 2012 and 2020, gold priced in bolivars increased by a factor of several billion. The gold itself did not change. The measuring stick collapsed. Anyone holding physical gold during that period preserved wealth that would have otherwise vanished. But here is the critical insight. They did not spend that gold during the crisis. They waited until stability returned, then converted gold into productive assets, real estate, businesses, farmland, at prices massively deflated relative to their gold holdings. Central banks understand this with perfect clarity, even as their public statements suggest otherwise. Since 2010, central banks globally have been net buyers of gold for 14 consecutive years. In 2022 alone, central banks purchased 1,136 metric tons, the highest annual total since 1967. In 2023, they added another 1,037 tons. China has been accumulating aggressively, adding to reserves month after month, while officially discouraging its citizens from questioning the yuan. Russia built gold reserves as sanctions insurance before the Ukraine invasion. Turkey, India, Poland, and a dozen other nations are stacking gold at rates not seen in half a century. These institutions do not buy gold to barter with it. They buy gold because they understand its function in currency crises. It is the reset asset. It is what remains when paper promises fail. And their behavior tells you everything about what they expect is coming, that their words carefully avoid saying. The United States holds approximately 8,133 metric tons of gold in official reserves, the largest holding in the world. This gold sits primarily at Fort Knox in the Federal Reserve Bank of New York. It has not been independently audited in a comprehensive way since 1953. The official valuation on Treasury books still prices this gold at the statutory rate of $42.2 per ounce, a number unchanged since 1973. At market rates, this gold is worth over $600 billion. Why does the US government maintain this reserve if gold is truly a barbaric relic with no monetary function? Why do all major central banks hold gold if it serves no purpose? The answer is obvious once you understand gold's true role. It is the asset of last resort. It is the foundation upon which new monetary systems are built after old ones fail. And the people who run the monetary system know, better than anyone, how these systems end. This brings us to the question of what is coming, and why understanding gold's real function matters more now than at any point since 1971. US federal debt has crossed $34 trillion. Debt to GDP ratios exceed World War II levels. Annual interest payments on the national debt now exceed the entire defense budget. The Federal Reserve's balance sheet, despite recent reduction efforts, remains bloated by historical standards. Simultaneously, the BRICS nations are actively constructing alternative payment systems designed to reduce dependence on dollar-denominated trade. Saudi Arabia is accepting yuan for oil sales. China and Russia are settling trade in local currencies. The petrodollar arrangement that has supported dollar demand for 50 years is visibly fragmenting. None of this guarantees imminent collapse. History shows that unsustainable systems can remain unsustainable far longer than logic suggests possible. But the pattern is familiar. The trajectory is recognizable. And when you combine domestic debt dynamics with geopolitical currency competition, the probability of significant monetary disruption in the coming decade is higher than at any point in living memory. If that disruption comes, the barter fantasy will be exposed as fantasy. The people who survive and thrive will be those who understand that gold's value is not in spending it during chaos. Its value is in holding it through chaos. Physical gold, held in your possession, not in an ETF, not in a bank vault, not in a certificate, but in your hands, represents the most ancient and proven form of crisis insurance humanity has developed. It cannot be printed, it cannot be defaulted on, it cannot be frozen by a foreign government or seized through digital account restrictions. It simply waits patiently until the storm passes and the rebuilding begins. The lesson from Berlin 1923, from Buenos Aires 2001, from Harare 2008, is not that gold would have bought you bread during the worst days. It would not have. The lesson is that gold allowed those who held it to emerge from collapse with their wealth intact, positioned to acquire assets at generational discounts while everyone else rebuilt from nothing. That is the real role of gold, not a medium of exchange during crisis, but a store of value across crisis. Not for survival during the storm, but for prosperity after the clouds clear. History teaches this lesson repeatedly. The only question is whether you are paying attention. Thank you for watching Infinite Wealth Historian. If this changed how you think about gold and financial crisis, share it with someone who needs to hear it. I will see you in the next one.